Look, I need you to pay very close attention to what I'm about to share with you, because what's happening right now in the gold market is something most people won't see coming until it's too late. And by then, the opportunity will have passed them by. You know what's fascinating? Right now, as I'm recording this, gold is trading near all-time highs. You'd think that would be the story everyone's talking about. But here's what nobody's discussing. The mechanics underneath this market have fundamentally changed. And I mean fundamentally. We're not just seeing a bull market in gold. We're watching the architecture of the global monetary system being rebuilt in real time, and gold is at the absolute center of it. Let me paint you a picture of what's actually happening. In the last 18 months, central banks around the world have purchased over 2,000 tons of gold. That's not just a big number. That's the highest level of central bank buying we've seen since 1950. Think about that for a second. 1950. We're talking about post-World War II levels of accumulation. The People's Bank of China alone has been adding roughly 15 tons per month to their reserves. The Reserve Bank of India bought 19 tons in a single quarter. Poland, Singapore, Turkey, they're all loading up. And here's the kicker. These aren't just routine purchases. These are strategic repositioning moves. But why? Why now? What do they know that the average investor doesn't? Here's where it gets really interesting. If you look at the COMEX data, something extraordinary is happening. The amount of physical gold backing each paper contract has dropped to levels we haven't seen in over a decade. We're talking about a ratio that's becoming increasingly unstable. For every ounce of physical gold in the COMEX warehouses, there are now over 100 paper claims on that same ounce. Let that sink in. 100 claims on the same piece of metal. Now, you might be thinking, well, that's always been the case with futures markets. And you'd be partially right. But here's what's different. The people who usually play the paper game are now demanding physical delivery. In the last 6 months, we've seen delivery requests spike by over 300%. That's not normal market behavior. That's a fundamental shift in how sophisticated players are approaching this market. I was talking to a bullion dealer in London last week, someone who's been in this business for 30 years. He told me something that should make every gold holder sit up and pay attention. He said, "For the first time in my career, I'm seeing institutional buyers willing to pay premiums of 3 to 5% over spot just to secure physical metal with guaranteed delivery dates. 3 to 5% premiums in a market that's supposed to be liquid and efficient." That tells you everything you need to know about the supply situation. But let's dig deeper into why this is happening. You've got to understand the geopolitical chess game being played right now. When Russia was hit with sanctions in 2022, something unprecedented happened. Over $300 billion of their foreign reserves were frozen. Just like that. Decades of accumulated wealth locked away. Now, if you're a central bank in China, India, Brazil, or any country that might find itself on the wrong side of Western policy, what did you just learn? You learned that dollars and euros held in Western banks aren't really your money. They're permission-based assets. Gold, on the other hand, is no one's liability. It can't be frozen. It can't be sanctioned. It can't be printed away. And that's why we're seeing this massive shift. The BRICS nations aren't just talking about creating an alternative to the dollar system. They're actively building it, and gold is the foundation. Here's a story that perfectly illustrates what's happening. In August of last year, a major European bank, one of the old guard institutions that's been around for over a century, tried to repatriate 50 tons of gold they had stored in London. Standard procedure, right? Except it wasn't. The delivery took 4 months. 4 months to move gold that was supposedly sitting in a vault, allocated and ready to go. When they finally got their metal, the serial numbers on some of the bars didn't match their original inventory records. Now, the bank never went public with this. Why would they? It would cause panic. But word gets around in this industry, and it tells you something crucial. The physical gold market is far tighter than anyone wants to admit. Now let's talk about what this means for the price, because here's where most analysts get it completely wrong. They look at gold and they try to value it like a stock or a bond. They talk about inflation-adjusted highs and historical averages. But that's not how you should be thinking about gold right now. Gold isn't just an investment anymore. It's becoming a monetary asset again. And when that happens, the pricing dynamics change entirely. Think back to 1971. Nixon closes the gold window. Suddenly, gold isn't $35 an ounce anymore. Within 9 years, it hits $850. That's a 24 times increase. But here's what's important. It wasn't a smooth ride up. It happened in waves. There were periods where gold would consolidate, where everyone thought the rally was over, and then boom, it would explode higher. We saw the same pattern in the 2000s. Gold bottomed around $250 in 1999. By 2011, it was over $1,900. Again, not a straight line, but a series of powerful moves higher punctuated by consolidations. What we're seeing right now feels eerily similar to those early stages. Gold has broken out of a decade-long consolidation pattern. It's making new all-time highs. But more importantly, it's doing it while real interest rates are still positive. Historically, gold struggles when real rates are positive. The fact that it's rallying anyway tells you the fundamental drivers have changed. This isn't about inflation expectations or interest rate policy anymore. This is about trust in the system itself. And here's something that should concern every investor. The disconnect between paper gold and physical gold is widening. If you look at the gold ETFs, particularly GLD, the largest gold ETF in the world, they've seen outflows over the past year. Money has been leaving, but the price of gold has been going up. How is that possible? Because the physical market is driving the price now, not the paper market. The tail is no longer wagging the dog. I want you to imagine something for a moment. Imagine you're a pension fund manager. You've got billions of dollars under management. Your job is to preserve and grow wealth for retirees. You've been told your whole career that a 60-40 portfolio of stocks and bonds is the way to go. But now bonds are paying yields that barely keep up with inflation. Stocks are trading at valuations that historically precede major corrections. And you're watching central banks around the world accumulate gold at record pace. What do you do? This is the conversation happening in boardrooms right now, and it's not just pension funds. Sovereign wealth funds, family offices, high net worth individuals, they're all asking the same question. Should we have more gold? And when that question shifts from should we to how much, that's when you see real money flow into the market. Now here's something practical I want to mention. If you're sitting on retirement accounts, IRAs, 401ks, and you're thinking about how to position for what's coming, there are ways to hold physical gold inside those accounts. I actually put together a comprehensive guide on how gold IRAs work, how you can get physical metal into your retirement account without triggering tax penalties, and what to look for in a custodian. It's completely free, and you'll find the link in the description below. If you've got $100,000 or more in retirement savings, it's worth understanding how this works, because the window to make these moves while premiums are still reasonable might not stay open forever. All right, back to the bigger picture. Let's talk about what happens next, because this is where it gets really interesting. We're approaching a point in the market that I call the recognition phase. This is when the broader investment community starts to realize what's happening. Right now, gold ownership among institutional investors is still relatively low. Most portfolios have maybe 2 to 3% in gold, if that. But if we see a shift where that number moves to 5 to 7%, which is still conservative by historical standards, you're talking about hundreds of billions of dollars of new demand hitting a market that's already struggling with supply. And here's the thing about gold. You can't just create more of it. Global mine production is roughly 3,000 tons per year. That number has been flat for the last 5 years. In fact, many of the major gold mining companies are reporting declining reserves. The easy gold has been found. What's left is deeper, harder to extract, and more expensive to produce. So, supply is constrained. Meanwhile, demand is accelerating. That's the setup for a significant repricing. But there's another factor that nobody's talking about, and it's potentially the most important one. The derivatives market. You see, the gold market isn't just physical metal and futures contracts. There's a massive over-the-counter derivatives market, where banks and institutions have created synthetic gold exposure through swaps and options. The notional value of these derivatives is estimated to be in the trillions. And here's the problem. These are paper promises backed by paper promises. If we see a real squeeze in the physical market, if delivery demands continue to spike, these derivatives could become a source of systemic risk. Think about what happened with nickel on the London Metal Exchange in 2022. A short squeeze forced the exchange to halt trading and cancel trades. Billions of dollars of positions were unwound. Now imagine that happening in gold, a market that's 10 times larger and far more important to the global financial system. The potential for disruption is enormous. I want to tell you about something that happened in 1980 that most people have forgotten. The Hunt brothers, Nelson and William, tried to corner the silver market. They accumulated massive positions, both physical and futures. For a while, it worked. Silver went from $6 an ounce to over $50. But then the exchanges changed the rules. They raised margin requirements. They limited position sizes. The Hunt brothers were forced to liquidate, and silver crashed. The point of this story isn't about silver. It's about what happens when markets become disorderly. The rules change. And right now, the gold market is showing signs of becoming disorderly. But here's the difference between 1980 and today. In 1980, it was private speculators trying to corner the market. Today, it's central banks and sovereign nations repositioning their reserves. You can't change the rules on central banks the way you can on private investors. This is a different kind of market dynamic, and it's far more powerful. Let me give you some specific numbers to think about. China's official gold reserves are listed at around 2,300 tons. But if you look at their gold imports, their domestic mine production, and the lack of exports, the math doesn't add up. Independent analysts estimate China's actual gold holdings could be anywhere from 4,000 to 10,000 tons. Why would they underreport? Because if the market knew the true extent of their accumulation, it would trigger a rush into gold that would send prices soaring before they finished building their position. Russia is in a similar situation. After the sanctions, they've been settling trade with China, India, and other nations using gold and local currencies. They're essentially operating outside the dollar system already. And it's working. Their economy didn't collapse the way Western policymakers expected. In fact, their currency has been relatively stable and their trade balance is strong. Other nations are watching this very carefully. Now, let's talk about the technical picture, because this is important for timing. Gold recently broke through a major resistance level that had held for over 3 years. In technical analysis, when you break through long-term resistance, it often becomes support. That means pullbacks should find buyers at higher levels than before. We're seeing this play out in real time. Every dip is being bought aggressively. That's classic bull market behavior. But here's what's really interesting from a technical standpoint. The gold mining stocks are starting to outperform the metal itself. This is significant because miners are leveraged plays on the gold price. When miners start leading, it usually signals that smart money is positioning for a sustained move higher. The GDX, the gold miners ETF, has broken out of its own multi-year consolidation pattern. If history is any guide, we could see miners outperform gold by 2 to 3 times over the next phase of this bull market. I want to address something that I know some of you are thinking. But what about Bitcoin? Isn't Bitcoin the new gold? Look, I'm not here to bash Bitcoin. It's an interesting technology and asset class, but here's the reality. Bitcoin is 15 years old. Gold has been money for 5,000 years. When central banks want to diversify their reserves, they're not buying Bitcoin, they're buying gold. When there's a real crisis, when the system is under stress, people don't flee to Bitcoin. They flee to gold. Bitcoin might be digital gold for a certain demographic, but it's not replacing gold in the institutional world. Not yet, and maybe not ever. Here's another angle to consider. The jewelry market. India and China together account for over 50% of global gold jewelry demand. That's roughly 2,000 tons per year. But here's what's changed. In these cultures, gold jewelry isn't just adornment, it's savings, it's wealth preservation. And as the middle class in these countries continues to grow, that demand is only going to increase. We're talking about billions of people who have a cultural affinity for gold that goes back thousands of years. That's not going away. Now let's talk about the elephant in the room. The US dollar. For decades, the dollar has been the world's reserve currency. It's been the foundation of global trade and finance. But that dominance is being challenged in ways we haven't seen since the end of World War II. The BRICS nations are actively working on alternative payment systems. Saudi Arabia is now accepting yuan for oil sales. The petrodollar system, which has been in place since the 1970s, is being dismantled piece by piece. What does this have to do with gold? Everything. Because as the dollar's role diminishes, something has to fill that void. And the only asset with the history, the liquidity, and the trust to serve as a neutral reserve asset is gold. We're not going back to a gold standard. That's not what I'm saying. But we are moving toward a system where gold plays a much larger role in international settlements and reserve management. Here's a scenario to consider. What if, in the next 5 years, we see a new international monetary agreement, something like Bretton Woods, but for the 21st century, a system where currencies are partially backed by gold, where international trade imbalances are settled in gold, where central banks hold significantly more gold as a percentage of their reserves. This isn't far-fetched. There are serious discussions happening at the highest levels of global finance about exactly this kind of reform. If that happens, if we move even partially in that direction, the amount of gold needed to support the system would require a much higher gold price. Some analysts have calculated that to back even 40% of global central bank reserves with gold at current prices would require more gold than exists in all central bank vaults combined. The math only works if gold reprices significantly higher. I want to share one more story with you because it illustrates the psychology of what's happening. In 2008, during the financial crisis, there was a brief moment when gold actually sold off. People were confused. Isn't gold supposed to go up in a crisis? They asked. But here's what was happening. Institutions were being forced to liquidate their most liquid assets to meet margin calls and redemptions. Gold was liquid, so it got sold. But within months, once the forced selling was over, gold began a rally that took it from $700 to over $1,900 by 2011. We might see something similar in the next crisis. There might be a moment where gold dips as people scramble for cash, but that will be the buying opportunity of a lifetime. Because once the dust settles, once people realize that the system itself is the problem, that's when gold will truly shine. Here's what I want you to understand. We're not in a normal market cycle. This isn't about whether the Fed is going to cut rates by 25 or 50 basis points. This isn't about whether inflation is going to be 2% or 3%. This is about a fundamental restructuring of the global monetary system. And in that kind of environment, gold isn't just an investment. It's insurance. It's a store of value. It's a way to preserve wealth across generations. The question isn't whether gold is going higher. The question is how much higher and how fast. And the answer to that depends on how quickly the broader market wakes up to what's happening. Right now, we're still in the early stages. Most investors are still skeptical. They still think gold is a barbarous relic, a pet rock, something that doesn't generate cash flow. But that skepticism is exactly what creates opportunity. When I look at the setup in gold right now, I see echoes of 2001 when gold was breaking out of a 20-year bear market. I see echoes of 1971 when the monetary system was being fundamentally altered. And I see something new, something we haven't seen before, a coordinated global move away from dollar dependence with gold as the primary beneficiary. The changes that are coming aren't going to happen overnight. This is a process that will unfold over years. But the positioning needs to happen now, while gold is still accessible, while premiums are still reasonable, while the crowd is still skeptical. Because once the recognition phase begins, once institutional money starts flowing in earnest, the opportunity will have passed. So here's what I want you to take away from this. Pay attention to what central banks are doing, not what they're saying. Watch the physical market, not just the paper price. Understand that we're in the early stages of a major repricing of gold relative to fiat currencies. And most importantly, make sure you're positioned appropriately for what's coming. Because everything is about to change. And gold holders who understand what's happening are going to be on the right side of history.